I have started recording, so you're welcome. You have about 50 minutes, but if it's longer or shorter, it's okay.
Okay.
Okay, please go ahead.
All right. Thank you, Stan. Thanks again for hosting me and allowing me to present. I'm Fred Viole, and I'm here today to talk about partial moments and their role in nonlinear statistics, as well as their role in quantitative finance. I'll have links that if you have further questions or emails, feel free to reach out. So first is we need an introduction to partial moments. They've actually been around since the mid-1970s. And this dates back to trying to come to better solutions than what Markowitz originally proposed in 1952, which was a geometric mean over semi-variance, as opposed to his mean variance. But computationally, they didn't get there until mid-70s. So I label partial moments as the elements of variance, and you're going to hear terms degree and target often. And this is your formula for your lower partial moment. And here's your degree, and here's your upper partial moment, which is the max of 0 versus. So any negative observation will be denoted a 0 in the upper partial moment. Partial moments, they're grounded in probability weighted integration and rigorously connected to measure theory. They could be time series or cross-sectional. So here's just some equivalences to demonstrate the basic statistics of partial moments. And if you're playing along at home, there's a library that I've built in R, package NNS, and here's all the functions to reproduce. So very simply, the mean of a variable is the upper partial moment, degree 1, from a 0 target, minus the lower partial moment, degree 1, from a 0 target. You can then multiply that by b minus a for an integral mean value numerical integration. And the other difference to get the total area of the function is you can sum the partial moments instead of just the net signed area. Variance, sample variance and population variance with Bessel correction. It is the second degree partial moments, upper and lower, from the mean target. And you equate then to your sample variance with the correction. And then if you had no correction term, you would achieve the population variance. Again, these are just degree 2 from a mean target of the variable. And you can also get there. We're going to show these functions later on, but it's also the covariance of itself. So you can determine the 4 covariances and then sum those together. But we're going to get into the multivariate in a bit.
Fred, I have a quick question.
Yes.
Do you have a PPT presentation? Because if you do, we're not seeing it. You might have to share your screen.
Oh, hold on one second, please. 11, Zoom. Thank you for.
It's good now.
Is that better now?
Yes, now we can see it.
Okay, thank you. Stan, you're supposed to tell me about that. We have it on the screen here, so Stan didn't care about the sharing. Okay, so again, this just to rehash real quick, these are your formulas for partial moments, your degree and target, and your max 0 condition. Here was the mean, and again, the variance. matching up to the sample, and population variance. Skewness, we can break this down into partial moments as well. And here's the corresponding skewness calculation from the performance analytics package. What you notice here in the partial moments recreation of skewness is you renormalize these third degree partial moments. And for finance, we're already dealing with normalized returns. So what you're doing is you're muting the actual measure by renormalizing it when it doesn't need to be. And I'm going to show later how partial moments are just a cleaner look at the intended effects of the distribution. And here's your kurtosis, which is degree 4 partial moments, again, normalized by the squared variance. The lower partial moment, degree 0, is an indicator function. And what we can do with that is match any empirical CDF. It's very easy. We just set the degree equals 0. We use the target as all values of X sorted. And we can see it aligns perfectly with the empirical CDF. This is going to yield a lot of insights in a bit. But we have to have this equivalence first. So now, if we change the degree, again, these are still empirical CDFs. All we've done is increase the degree in all of these. You can see what it does to the CDF and corresponding PDF. What you've done is you've fattened the tails.
What is horizontal? What is the vertical scale in this graph? What are you speaking about?
Okay, so these are the CDFs on the left plot,
Okay.
and these are the PDFs on the right plot.
Okay, for different distributions? Or-
No, same distribution X.
Yeah.
All we've done is we've increased the degree in the partial moment function
Okay.
and then ascertained the corresponding PDF and CDF. So what you do when you increase the degree is you put more emphasis on tail returns. And you can see what that does, how that
I don't understand what is PDF. You just showing the graph of partial moment? Or?
yes. So here's the empirical CDF with the lower partial moment degree equals 0.
Yeah, which is exactly what the CDF is.
Correct.
But
So now when you increase the degree to 0.25, 0.5, 1,
it's already
2,
not CDF, it's just partial moment, right?
it's still a CDF because it's bound from 0 to 1.
So it's a CDF of some other random variable, or
It-
something like that.
Well, what it does, again, well, I'm going to get into it. Utility theory is your subjective probability to returns. And this could represent your subjective return probability distribution when you increase the degree, depending how risk averse or risk seeking you are. So that gives us the flexibility to generate these distributions with fatter tails. Comparing CDFs also led to stochastic dominance, which is, you know, a very efficient method of implementing risk preferences into sets of securities. So what I did here was using the lower partial moment representation of the CDFs, you can now quickly and easily go through and pick out sets of securities that are not dominated. So in this one, you could see, imagine this was my visualization of it. These were CDFs, and crossing CDFs don't dominate one another. They are in the same set. So you could see here that this would be security 4 is dominated by security 3 and is then not included in the set.
Where you show with your mouse, I don't see pointer.
You don't see that?
Okay.
Right there. Third column, final row. So you could see security 4 is dominated stochastically by security 3. So it's no longer considered, but security 3, 2, and 1 all intersect, and their corresponding CDFs would intersect. And so that would be your stochastic dominant efficient set. And you could do this now for different degrees of stochastic dominance, first degree, second degree, third degree. And you can control those degrees here with the degree in our partial moment function for the CDF.
Can you explain this a little bit from like the first 2 or 3 graphs? Because what are those graphs representing? That the CDF?
This is just, yeah, this is just supposed to be, it was a braid theory representation of the crossing CDFs. So if CDFs intersect, they don't stochastically dominate one another for a given degree.
First order.
Yes. So if you did have one that was shifted, like variable 4 here, it would be dominated by 3. But 3 is not dominated by 2 or 1. So your efficient set of securities is 1, 2, and 3. 4 is left out per the stochastic dominance criteria. That make more sense? So you can see here, all of them cross. They're all in the stochastic dominant efficient set of securities. In this one, security 2 is dominated by security 1, so it's not necessary.
How do you see
This one, and you see bottom,
yeah, it's a 2, but how do you see that it's dominated by security 1?
because it's constantly underneath it.
Oh, so, oh, no, that I cannot see. Okay.
And-
Because you see when those lines are above or below,
Yeah,
I
no,
don't
but
see it. Yeah.
so you have to test and come up with a test to pairwise test all of the possibilities, and you rank them, you know, by LPMs and minimum observations, and you go through.
Okay.
So that's the stochastic dominant efficient set of securities. There's CDFs. Anyone that's dominated is cast aside. So that was the univariate partial moment equivalences. This is really where the rubber met the road, and I had a lot of breakthroughs, was when I defined the multivariate partial moment matrices. So you can see here the co-lower partial moment in the lower left, your 2 divergent partial moment quadrants, and your co-upper partial moment quadrant. Here are the formulas. Again, you'll notice the shifting of the targets for the divergent ones and the cos. So using these quadrants, we can recreate the covariance matrix by adding the 2 co-partial moment quadrant matrices and subtracting the divergent matrices. And the function in my package, PM matrix, returns each individual matrix as well as the corresponding covariance matrix. And
But that's what I mentioned too, right? That's when you have 2 random variables, and so you're supposed to have 2.
yeah. So there's always 4 matrices, no matter the dimension. And I'm going to show you, you know, when I do it on the Mag 7 stocks, it's a 7x7. You get 4 7x7 matrices. So here is the reassembling of it. You sum the co-partial moment matrices, and you subtract the divergent matrices. And now we have identically equal to our covariance matrix. And you'll notice that the degrees are 1 for upper partial moment and lower partial moment.
Sorry, I'm confused. For variance matrix, you have n by n
Correct.
n securities, but here you have a 2-dimension graph.
Oh, because
with-
it's only a 2-dimensional security. It's only 2 dimensions I'm presenting with. but I'll show you later on, there's 7 by 7.
So it's valid for any dimension.
Oh, n by n, yes, correct.
Okay.
Again, this I wrote in C++, so it's very efficient in the back end of R.
Also runs in C++.
Yeah.
So this thresholds, it's just you take some threshold for each variable
Correct.
independently, and you take those, what they are called, quadrangles? No.
Quadrants.
Quadrant.
Yeah.
Yes. And basically compute the covariance for the returns in the quadrants,
Correct.
sample covariance.
We're gonna get, you're skipping ahead a few slides. But so again, the target is vectorized for, and I just summed it up with mean, which means take the mean of whatever n variables you have, and that's your target. That's the corresponding covariance matrix settings. You know, just as an aside, the mean of a variable doesn't really matter as much as, say, like my cost of capital or something. So if I change that threshold, I'm going to get a different covariance matrix. And we can also generate copulas from the co-lower partial moment function. Again, it's just one line of code. It's very simple. We're expanding the observations, and we're taking the co-lower partial moment on these expanded observations. And this is on the raw data. And then this is if we further normalize the data and sample. And we can further normalize it with our LPM ratio, which is just the LPM over the LPM plus UPM, which is I gave a shortcut function to. We're going to get into stress testing in a little bit too. So this partitioning, this might be difficult to see. This iterative partitioning of the quadrants led to some insights that dependent variables typically had all of their observations within the co-partial moment quadrants. Alternatively, dependent variables could have all of their observations in the divergent quadrants, meaning they're negatively correlated, but they're still dependent upon one another. So that led to a new measure of correlation and dependence based on these partial moment quadrants. And I compare it to mutual information, distance correlation, Chatterjee Z. It's fairly robust on nonlinear signals. And again, it offers the correlation, which has a sign, and the dependence of these variables, which is between 0 and 1. So those are new metrics.
You're supposed to write a book about that. Have you published a book or anything?
I did. It was terrible. I just did it as a collection of white papers to timestamp that I came up with these ideas. My co-authors were the ones who were supposed to do all of, like, the review of literature and writing and stuff. And it was my job to just think and code and stuff like that. I'll get into that over lunch.
Okay.
So the nonlinear regression method was born from this too. I noticed that when I kept iterating these quadrants and partitioning each quadrant further, that those central points tended to fit the function that was in the joint distribution. And then I figured I'll just connect them linearly, and I'll have a local linear regression method. So what this accomplished, this iterated partitioning, and so I can do means, medians, modes, whatever I want, is a dynamic bandwidth solution to a kernel regression. So kernel regressions, through cross-validation, leave one out, typically have a static bandwidth across the support of the regressor. This is very dynamic because it's data-driven, and it, based on where the observations are, it will partition that space only. So if you had a function was multimodal and you had a space in between them, you would not be partitioning in between that space because there's no data to partition there. So again, it looks for local means, and that's your bandwidths. And so I did a whole bunch of papers and research with a co-author from Fordham. We published on this method, and this actually lent itself to very easily extracting partial derivatives also, because I have local linear segments on the function. And internally, I use the dependence function to say how many partitions should I make in this regression. So more dependence leads to more partitions and a tighter fit.
So again, say, what is it for? Why you are interested in this partitioning?
Because this is a nonlinear regression method that's a consistent estimator of f of x.
And how it's different from standard nonlinear regression?
Because it's not a static bandwidth like a typical in a kernel regression. The bandwidth is dynamic based on the iterative partitioning wherever these observations are at, and you're getting local means or medians or whatever. So you can see that the spacing along the support of x is not uniform.
That nearest neighbor.
That's what we're going to get to that. That's where the multivariate comes in. You're a slide ahead, pal. So again, I extended this now to a multivariate regression where, again, I'm partitioning each independent variable based on these iterative partitions, and it essentially is laying out a grid along the bottom here. And then what I do is for each grid point, I compute in this volume area the mean. And what you do is you see as I increase the order of partitioning, you have more and more of these centroid means until finally you have a perfect fit. So it's similar, the multivariate regression is similar to a KNN, K nearest neighbors regression, but it's doing it on centroids, not observations. And then I built a function to cross-validate the number of centroids to use for inference and stuff like that. This happens to be very good at extrapolating beyond the support of regressors, whereby polynomials and other kernels and even random forest would leave just a flat static estimate beyond support. This is actually capturing some of the dynamic increase and functionality outside of the support of the given regressors. We're going to use this later on in stress testing. Once I had this regression method, then I was trying to think of different ways to apply it. And obviously time series is huge. I came up with a method for time series forecasting, which instead of the ACF and PACF, I use coefficient of variation to determine the relevant seasonal periods in a given series.
What is ACF and PACF?
Autocorrelation and partial autocorrelation function from like an ARIMA or
Okay.
Larch method. And so I got away with that. And
So in your case, in your kernel regression, you have adaptive bandwidth, but it's locally linear, right?
this is local linear for the univariate, correct? And the multivariate is a like K nearest neighbors.
So why is it better in the extrapolation?
Based on the gradients that I determine internally. And it uses an observation weighted like gradient scheme to try and figure out where is this thing going.
So it's adaptively fixed the bandwidth based on some gradients information from local.
Yeah, from that local partitioning, yes. So that's why it actually works out of support. So this is an example of a linear regression on these subsets. This was quarterly data for an electricity, and you could see I'm simply just performing linear regressions on that relevant subset of observations. And then this is your forecast. But then I thought I should put the nonlinear regression method into this. So I'm picking out the seasonal periods, and this is an example of how it fits for 336 observations out of sample. This is using the nonlinear regression method. So I built an optimization routine which tests all seasonal periods and then tests linear, nonlinear, a combination of both, weighting. That's a different function in here. But in short, it uses the nonlinear regression method here in time series forecasting. And then I extended it to create a non-parametric vector autoregression, which then I've turned into a nowcasting model for economic variables. We can also do generative and synthetic data by using the maximum entropy bootstrap for time series. The professor Viole that I worked with at Fordham on the regression work had a package in R which was designed for bootstrapping time series specifically, and it kept the relative order of observations, and the only criteria that he had received over the years was every replicate was a perfect correlation to the underlying time series. So he asked me to look at it, and I came up with a method to specify a correlation coefficient or a rho to your underlying series. So here's the NNS me boot, here's air passengers, 100 reps each one. We can sample the spectrum from -1 to 1 of correlation coefficients for your replicate time series. And we can also change the drift later on. So that was a big advancement. And this actually led to a new method of Monte Carlo sampling, where I'm testing the spectrum of future correlation paths for a series, not your standard issue, fit your mean, your drift, and your standard deviation, and just IID it. So it's different. And here's where we can change the drift of the underlying series. And what's really useful for that is obviously putting in the risk-free rate for your drift for your time series. So all of this that I've just gone over, and there's actually more, ANOVA and normalization and stuff like that, is in the NNS R package, which is on CRAN. I've been maintaining it for 9 years now, and just keeps getting better and faster, and integrating more C++ in the back end to really facilitate larger data sets and stuff. Now that we have this toolkit, now we can actually put some finance applications to it. First would be stress testing. So what we're going to do is restrict the observations to the CLPM quadrant, which was this one. When everything's going down together, we want to restrict our observations to this set. And then we can use the regression method to extrapolate beyond the support of the CLPM empirical observations. And we're going to reverse the procedure. So in a copula, you could say, oh, what happens if the S&P drops 10%? And then you could find your matching variables and get a point estimate. But through testing and using a whole bunch of out of sample returns and a range of returns for the securities as regressors to the S&P 500, we could say what portfolio returns would lead to an S&P 500 drop of 10%. So we actually get, bless you, a distribution
What portfolio are you doing? Which
So right now-
portfolio do you have in mind?
Right now, this is just the Magnificent Seven, but you can do it on the S&P 500. Again, any number of observations or dimensions.
Hello, so what are the factors here and what are you predicting?
Okay, so I restricted the all of the securities observations to their CLPM.
Okay.
Quadrant. So-
But there are 500.
Yeah, they could be 500 securities. I'm doing it right now with 7. So you can see.
Picked up some 7 and
Yeah.
doing analysis.
You know, your Apple, Nvidia,
Yeah.
Tesla. So this is it. And you could say now, what is the distribution of losses for each security that would lead to a 10% drop in the S&P 500, my dependent variable in the regression. And this is the distribution you're given now on losses for each of the Mag 7 components on your S&P 500.
So you're checking individual securities impact on S&P 500, something like that.
While maintaining the dependent structure of the multivariate regression. That's the key. So partial moments also are very big in utility theory. I've several papers I wrote on expanding partial moments use in utility theory. It's important. Markowitz in his book dedicated a quarter of his book to utility theory. It wasn't just to fill pages. It's because it's a very important part of portfolio theory, whereby like each of us have unique risk profiles, different costs of capitals, subjective wealth. So by parsing the variance, you're able to reflect these subjective interpretations more accurately. And partial moments are perfectly suited for this. So here's some examples of some utility functions using our partial moments. And your target could then be your cost of capital or some threshold return that you need to meet for an obligation. So if you had a 6% obligation, a return of 4% isn't actually a gain for you, is it? It's not good. And so our loss aversion parameter is N in our lower partial moment, and our gain seeking parameter is Q. And here's your effects, concave to convex for both losses and gains. Here's the utility function I came up with based on these partial moments. And you can see up top left, this is just a linear representation, and nobody is linear with regards to losses, especially, but gains as well. And how I determine risk aversion is by the ratio of our degrees N to Q. And loss aversion is separate from this ratio. So you can be loss averse in the bottom right here while gain seeking. And you could actually be risk seeking while maintaining this loss aversion. So you could see what happens when you increase the degree to 2 for both of them. Using 2 benchmarks. And again, I traded my whole life, so I would always have like a stop loss and a target limit. So I always had 2 reference points in my head. You can see you maintain prospect theory within those 2 benchmarks. Now, prospect theory went through great lengths to describe a 4-fold pattern of risk, but ultimately had a 2-fold value function because they were bound by a single reference point. By incorporating 2 reference points, like a loss limit and a target limit, we can achieve that 4-fold pattern of risk that they've identified. It's also discontinuous at 0, whereby a break even could be either, a relief or an opportunity cost. Some people will continue to do something if 0 return happens, and that's a positive utility generated for them. And other people will view that as an opportunity cost and not do something, even though they've achieved zero return. You know, other functions force utility of zero to equal to zero just to make it differential everywhere. But aside from that one point, it's not necessary. So we expanded works on two-piece utility functions from Fishburne and Koshenberger. So this is in the literature going back to 1981, 82. So with these parameters and these moving, shifting targets, we can fit any known utility function in the literature and then match this function to your individual preferences. Here's something that I figured out that was actually very useful. I can build these utility preferences directly into the covariance matrix by altering these degrees and targets that we showed earlier was degree 1 and mean targets for our regular covariance matrix. Now, if we had gone to degree 2 and a 5% or risk-free rate target, you'll have a different covariance matrix based on your subjective risk profile.
So it's covariance matrix for what?
For your subjective probability distributions, representing your utility function, however risk averse you are, however risk seeking you are, because these degrees, I can now just alter this covariance matrix directly, which then bypasses any scalar used for risk aversion in like mean variance optimization or stuff like that, because you have your risk profile built into your covariance matrix already.
So this assumes something about the distribution, right?
No, it
Okay,
assumes
that's-
your risk preferences.
No, but the mapping between risk preference, your utility functions, and the ability to represent them with 4 matrices.
Oh,
there
yeah.
has to be some distribution.
No, this is all empirical. All non-parametric empirical, given your observations. Again, so you're matching up to the empirical covariance matrix.
Right.
So there's no functional form assumed in
Okay,
any of
okay.
this. So now what we do is we alter these degrees and targets for your personal situation. Just some properties on these matrices. The co-lower and co-upper partial moment matrices are both positive semi-definite. And here's your 7x7s, by the way. Your divergent matrices are transposes of one another. So they're fairly easy to work with. And of course, this leads to more logical objective functions. We all want to minimize the co-lower partial moment matrix, and we all want to maximize the co-upper partial moment matrix. Coincidentally, by minimizing this matrix, you're also minimizing the correlation of variables in the co-lower partial moment matrix because it's just the unnormalized lower covariance matrix. Bless you. And the same thing is now with the upper partial moment, we want to maximize that, which would say maximize the underlying correlation of that matrix, which is saying we want everything to go up together. So we only want diversification on the downside when we need it. And then you'd have to squeeze everything out of the divergent matrices. So when maximizing and putting these returns with these partial moments into portfolios, we still haven't touched on the fact that returns in the future look nothing like returns where you're at today. And if you generated a mean variance efficient portfolio on the frontier at time t, at time t plus n, your mean variant efficient portfolio will be somewhere else in that region, not along the frontier. That's just the non-stationarity of returns. Actually leads me, I wanted to do a study to see if there was any geographical region from the efficient set that most likely went to the efficient frontier next period. There's always something I wanted to work on. So what I did was, here's a longer post and paper. I mean, I could go on for an hour just on this paper. What we did is we took S&P 500 companies over 3 10-year periods and did 1 year and 2 years out of sample. And I conditioned the returns with entropy proxies. And the entropy proxy I use is 1 minus the autocorrelation of those returns. And why is that? Is because if the future is uncertain, then if we're certain today, that's the least place we want to be. So you're upholding Knightian uncertainty by penalizing for certainty today. And we generated significant rank correlation for 1 and 2 year holding periods out of sample in that study. And again, there's a whole lot more on that. For other portfolio theories, they don't even come close. They diversify for just because they don't like the results from mean variance. But they typically whitewash utility theory and or generate it for a specific assumption of risk averse everywhere. You might be familiar with HRP, which is supposed to be more robust, or stochastic portfolio theory, which, you know, tries to maximize growth rates. But, you know, you go back to Samuelson and his critique of mean log of wealth, that how you get there matters. It's not the final growth rate, because there's career risk if you have a 60% drawdown, but even though you're maximizing your growth rate. I sent all of this and had correspondence with Markowitz for several years. And again, it was just very fortunate and lucky that he took to my work and was engaging with it, and told me that I demonstrated a general portfolio theory of which mean variance is a subset, but he felt it was too complicated for me to get the message out effectively. So that he was not letting go of mean variance. That's for sure. But yeah, we had very good conversations. So in comparing to HRP, which just does naive clustering and seriation of the covariance matrix, I came up with iterative stochastic dominant clusters. So you take it, you get your efficient set for a given degree, and then you apply stochastic dominance on the outcasts. And then you keep doing that until you're left with the minimum number of securities. So you can cluster now based on stochastic dominance. And here's the degrees 1, 2, and 3 clustering. And this is how it fares versus just the naive seriation in HRP, completely out of sample for a year. You can see SD 1, 2, and 3 all outperform HRP and 1 over N for a year holding period based on these clusters. And again, HRP doesn't have any utility or risk factors in it. But stochastic dominance has corresponding risk profiles to each degree of its stochastic dominance. I built several apps for all of this, and created a website for subscriptions. But so the macro now uses the non-parametric vector autoregression on 30 Federal Reserve variables, and creates a GDP nowcast, as well as like 30 other variables, CPI, unemployment. Came up with a new options model based on upper partial moments for calls and lower partial moments for puts. And again, the portfolio method, where I ascertain your risk profile through, you know, several questions, and then come up with your corresponding partial moment degrees, and then build your portfolio there. The macro forecast has been very good. It actually nailed a 5 sigma GDP estimate back last year. my estimate was 3.4, it came at 3.3, everyone was at 1.8. It's really good when it works well. The options pricing, I don't need ND1 and ND2 anymore, and I was able to preserve P while adjusting for Q, and then shifting there. So I'm retaining the empirical distribution more so than, and here's the normal reference and your current stock price, your strike price, and then your break evens for your puts and calls from that given strike price. So that's an app I built out for that. Here's the portfolio tool. You say you're like, oh, you're how am I in time? I think I went over. I'm sorry.
Oh, it's okay.
So this is the
We are not-
portfolio.
We are not constraining you.
Vulnerable, and this is how it's done like over the last couple weeks with this volatility. The long short portfolio for the S&P 500 for a risk neutral investor is actually up, you know, what is that? Several percent.
What is the graph? That's
So the red line is your portfolio. This is all out of sample. So it creates a training set from a month ago if you wanted to hold it for a month. And blue is the 1/n of the S&P 500, and the gray is the S&P 500 or whatever benchmark. And here is your securities and your weights and their out of sample contribution to the portfolio. So finally, I used all this information to come up with some more informed dispersion metrics, whereby I break down dispersion into a lower dispersion and an upper dispersion, and create an algorithm for trading the S&P 500 with a maximum position size of short 2 or maximum position size of long 2. So I'm trading just the SPY based on the dispersions, the downside and upside dispersions of the index components.
I missed. What are the instruments in your portfolio? S&P 500.
In this one, yeah. Oh, so this one you could do S&P 500, you could do Russell 2000, you could do
So you trade individual stocks.
on this one, correct. So any universe you set in, I have 3,200 securities, top 100 ETFs by assets under management, sector ETFs, Dow 30, QQQ, Russell 2000, REIT index are all pre-populated indices I have. And then you could pick however many securities you want to add in your universe to then generate your portfolio for based on your risk profile. But that's separate from this. This is just a SPY trading algorithm that looks at dispersion of the index constituents. So every hour it goes through, downloads all the data, creates a dispersion metrics, the lower and upper, comes up with their ratio, and then buys or sells based on that upper to lower ratio, which is more informative than just an overall dispersion metric. And this is how it's done out of sample. I have it connected to an API at Interactive Brokers, and it's doing great. This month it's actually midway through. It's flat while the S&P is down 7%. And again, that's just using these. So it's better stats to ARB for a stats ARB. And then you could follow on LinkedIn if you want. And finally, I built a GPT based on all of my research that you can go in. It's completely free and open and just query away. And it was built on all the theory and underlying code in R. And that's it.
So what the GPT is doing, what? Answer some questions?
Yeah,
or-
whatever, or give me the code. How do I do this in partial moments? There's a caveat that everything's in R. So if you're working in Python, you're SOL.
You can ask ChatGPT to convert all your R's over into Python.
Yes. The reason I got into R because Rishikesh Vinod from Fordham used to work at Bell Labs, and he worked with Tukey and he worked with Fishburne back in the day. And Bell Labs had S and then migrated to R, and he had always worked in R. And before I met him, I had everything in Excel, and it was just a nightmare. So I learned R, created the package, and then now I'm learning C++ and making everything like faster and better.
It sounds exciting. Are there any questions from audience here? You have so many ideas.
I know,
it's
I'm
just
sorry,
just-
it's all over the place.
Just unbelievable.
But it is really just one big giant idea of using partial moments to generate these nonlinear insights to then maximize. Again, I had no interest in getting into utility theory, none at all, but it was necessary. And that's actually what started my conversation with Markowitz, was the utility work.
Maybe ask, maybe if Zoom audience have any questions.
Any questions from Zoom? I think everyone fell asleep.
I don't think so.
No, that, your presentation was fascinating. Is very, very interesting.
Thank you.
Yeah, so people maybe know.
I know I'm throwing a lot at
Maybe-
everyone all at
maybe
once.
20% of things which you mentioned, people don't have so breadth as you have.
No, I'm again, if I can come up with this stuff, then it's easy. It just
Okay.
took a lot of time and trial and error for me to iron out all the bugs. Plus, again, I had great co-authors, David Naraki from Villanova, Rishikesh Vinod from Fordham, and I had the luxury of sending Markowitz all of my work, and he would offer commentary and we would discuss it, and it was great.
Okay, thank you. Thank you, Fred. So I have slides and also have did recording, so we probably will try to learn more because we
Okay.
have so many ideas that it may take some time for us to digest this.
I that's why I built the GPT, because everyone's got like a lot of questions, and go at your own pace.
Okay, great. Okay, thank you again.
All right.
Let's
Thank you, guys. Appreciate it.
Let's finalize the session.
Thank you.